Hello, everyone. Welcome to yet another episode of Expert Speaks. We are in the middle of a market correction. People are disturbed. A lot of people have invested in a lot of SIPs, particularly youngsters of today, are attracted to returns generated by the small cap, mid cap. They are big time into the SIPs of mid and small caps. I was going through a data recently where it's showing that a lot of people have stopped SIPs. Obviously, people could be considering stopping these SIPs in case if this market correction proceeds in the same fashion. It's time to really think, is it a good idea to stop the SIP now and restart at some point of time? Or what is that need to be done? We need to be guided by the professionals. We need to be guided by history, and we need to be guided by the hard data, which tells, is it beneficial for people to continue the SIPs, pause it, or restart, or take any other measures? So, to answer this question, we have called a very eminent guest speaker on our channel today, and he's going to answer based on his research what is the best course of action you need to be taking today. Watch this episode till the end, and I'm going to discuss a lot of questions, and you will get decisive answers on the doubts that you could be having in your mind. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about what is the right action that you need to be taking today with respect to your investments in stock market as a whole and SIPs in particular, we have on our channel a very esteemed, respected guest speaker, Mr. Manoj Jain. Mr. Manoj Jain has over 16 years of experience in this market. Currently, he is working with White Oak Capital. He is a CFA by qualification, has extensive experience of traveling, conducting investor education programs across length and breadth of this country. He has conducted till date over 1,000 odd investor education program. He is a regular contributor to the business channels. He has worked prior to joining White Oak Capital with ICICI Prudential. He is a person who is involved in strategizing the product design and things which are pertaining to that. Welcome to this episode, Mr. Manoj Jain.
Thank you, sir. Thank you so much for inviting me.
Mr. Manoj, audience is really disturbed. It's
Mhm.
not easy to bear with this kind of a bear market. Large caps have corrected by 12-13%, whereas
Mhm.
the small caps show roughly about 25 odd percent. It's just not 25% uncertainty of the future. What happens tomorrow? Large caps fall by 1%, and the small caps crack much more than that. So they are not in a position to understand what they should be doing. I just came across some report a few days before where there is a massive stoppage of SIPs by these new time investors. I don't blame them. They are young. They have come newly into the market. They don't have an experience around it. And nobody likes the portfolios bleeding or, the fear of losing that money. So we thought we'll talk to you. You have done that extensive work on the various data pertaining to the SIP. So I just thought I'll ask you these questions, which have been asked to me in our comment section by various of our viewers. And please help us with the data, support it with the data, as well as from your experience. You have 16 years experience. Your job involves every day, talking to people on the same questions that our customers also have. My first question to you is, amidst this bloodbath, should the investors who have SIPs which are running, should they stop? Should they pause? Should they wait for an opportune moment to restart the SIPs? What's the best course of action that is available for an investor today?
So we did some study pertaining to these questions because these are not new questions. Every time there is some correction in the market, we see a lot of people stopping their SIP, especially people who have started very recently. So I'll give you two data points. So we did study for about last 28, 29 years of Sensex data, which is a popular index in India. So let's say you are somebody who wants to do a 10-year SIP. So over the last 29 years, no matter on which day you would have started your SIP, on an average, the 10-year SIP return is about 14%. Here, I should put a disclaimer that past performance may or may not sustain in future, but just as a reference point, over the last 29 years, a 10-year SIP on an average has generated some 14 point something return. Now, the interesting thing is, for those investors where the first 5-year SIP return is poor. Now, what is the definition of poor? Let's say even after running your SIP for first 5 years, your SIP return is less than 8%. Why 8%? Let's say this is the hurdle rate. Okay, because let's say bank FD, which is very safe, is also giving some 7-8% return on an average. So let's say we are talking about those investors who have started SIP and initial 5 years are pretty bad, below their expectation in terms of return. Those investors who are generating less than 8% return in first 5 years via SIP, when they end up completing 10 years, they generate something like 18% on an average. So let me summarize once again. If you are doing a 10-year SIP over the last 29 years in Sensex TRI, the average 10-year SIP return is about 14% XIRR. But for those investors whose first 5-year returns are poor, when they complete 10 years, their SIP returns are somewhere around 18%. And that is very obvious because initial 5 years, if the return from the market is poor or let's say negative, that means you are getting more units for every installment of your SIP. And eventually, when market recovers, you will get rupee cost benefit because that is the whole reason why you are starting SIP. So this is data number one. You should feel very lucky if your first 3, 4, 5-year returns are poor. You should feel very lucky that my 3, 4, 5 years are poor. My SIPs are doing better averaging. Eventually, when markets recover, I will get better return. So this is point number one. This is data number one. So now let me give you another data point because a lot of people are now talking about mid-cap SIP, small-cap SIP, and obviously the recent experience is very poor. So instead of talking about last 30 years, let's talk about last 5 years because that is when bulk of the investor have started investing last 3, 4 years, 5 years after COVID. And a large event which took place, which we are discussing, is COVID in 2020. So let's say we are talking about an investor who started SIP just before COVID. Let's say in December 2019, about 5 years back. We are discussing this in Feb 2025. So till date, this investor who would have started a 10,000 rupees monthly SIP would have invested 6,10,000 rupees, which is 61 installment. The value of this 6,10,000 rupees today is about 12,10,000 rupees, even after this recent correction, and the XIR return is about 27%, 27.3% to be precise, as on 31st January 2025. Now let's take an example of another investor who would have waited for the correction because somehow magically he knows that there will be COVID and there will be 38%, 40% correction in the market. And this investor would have started SIP on 31st March 2020 after the COVID crash, right at the bottom. Now, because this investor started SIP 3 months later, total investment would have been 5,80,000 rupees, 30,000 less as compared to the previous investor. The current valuation as we speak, as on 31st March 2025, would have been 11,15,000 rupees. Even if you adjust for 30,000 rupees, that lesser amount that he has invested, he would have made 66,000 rupees less as compared to somebody who would have started SIP before the crash. And the XIR return is almost same, 47.4%. In first example, it was 27.3%. It is 24.4%, which means in terms of percentage return, there is hardly any difference. There is marginal difference. But in terms of wealth creation, the person who started SIP just before the crash has made more wealth, even after adjusting for higher or lower amount. Now, let's take last example. Let us build a scenario that if somebody would have started SIP in December 2019, 5 years back, and there is no COVID crash, market remained flat because there was a crash and then market recovered by October 2020. Let's say market remained flat. There was no crash at all during Feb to October. Now, this investor again would have invested 6,10,000 rupees, 61 months, 10,000 multiply. The value would have been 11,64,000 rupees and the XIR would have been 25.6%, even lesser. So the point is, corrections are healthy. Corrections are good. Volatility is good. You want, if you are starting SIP and if you intend to run it for long term, you want these kind of correction because that is when rupee cost averaging will give you the best benefit. That is when you can average at the lower end and you can get more units for the amount you are investing.
Manoj, see, the investors start the SIPs. Now they are disturbed that their returns are lesser. Now you answered that question. If initially the returns are lesser, in the long run, it works out in their favor. They have to bear with the present pain. I remember somewhere somebody circulating something on the WhatsApp. In the stock market, you always keep gaining. They said that if the markets are doing very well, you gain on the price side, valuation. If markets are not doing well, you gain on the unit side. So market, you always keep gaining. And there is no meaning for each of this without to one another. So they have to alternate. So you have to keep gaining unit and you have to keep gaining price. And it doesn't happen together. They happen in cycles. So people have to understand this. But the question is the unlimited period of time which is required, as we all profess, the investor is not prepared to give. What is an ideal investment horizon for a SIP? What the ideal horizon for which they have to do SIP? 6 months, 1 year, 2 years, perpetual. What does your data that you came from the research is suggesting you?
Sure, sir. So let me read a few data points from the report itself. I have this report in my hand. So we did this analysis for last 28 years of data of Sensex TRI, that somebody starting SIP for 3 years, 5 year, 8 year, 10 year, 12 year, 15 year. So these are the various illustration we have taken for this example. So somebody who would have started 3-year SIP at various point of time over the last 28 years, there is an investor who would have got some 50%, 50% XIRR, because his SIP period would have coincided with bull run with the market. There is an investor who would have got negative return also. In fact, the probability of a 3-year SIP to generate positive return is only 85%. I use the word only 85% because obviously you want your SIP to generate positive return at all point of time, and you want your SIP to generate at least double-digit return at all point of time. So which means if you are doing a 3-year SIP, there is a 50% probability, at least historically, data suggests there is a 15% probability that you end up generating negative return also, even on a 3-year SIP. But if you increase your time horizon to 5-year to 8-year, an 8-year SIP historically in Sensex TRI has never generated negative return. So this is point number one, that if you are doing an 8-year plus SIP, the probability of generating positive return is almost 100%. And in fact, the probability of generating double-digit return is about 82% times. 82% times an 8-year SIP has generated double-digit return. And if you increase your time horizon to 10, 12, 15 years, the probability of generating double-digit return is about 95 to 99% times. In fact, the probability of generating, let's say, 12% plus return on a 12-year SIP is more than 77%. So in short, I think while it is advisable that you link your SIP tenure with your financial goal, but I think you should do at least 8 to 10-year SIP to truly get the benefit of SIP concept by taking benefit of complete market cycle.
When I heard you, I am getting an impression that anything could happen in the short term. It can be a superlative return, it could be a lackluster return, it could be a stagnant return. But as the time horizon increases, the predictability or tendency for a positive return increases. And the best returns are got when you hold it for longer. How long? The longer, the better. It could be 10, 12. Over a longer period of time, it becomes predictable and it maximizes. So that's something that the investors have to keep in mind. So SIPs are not 2-minute noodles. SIPs are not something like an instant coffee. SIPs are an evolutionary product, takes time, but invariably delivers. And data can't be misleading. What we cannot predict in any SIP is that this is the exact number you get, that cannot be predicted. But what we can definitely say from the data is it gives you far better return than a bank FD, the alternative that you have. So you take for any particular period of time, you will get return. The price that you have to pay is you have to bear with the volatility, bear with the pain of seeing your portfolios not doing in the initial stage. If you manage this, then SIPs will never let you down. Is it a fair statement I have made?
Yes, sir. Perfect.
Now I have got an investor who is moved by this mutual funds EI campaign. He is yet to start investing in the market. Now he has a dilemma. Markets are in a corrective phase now. Should I stop till the markets turn around and start moving upward? Or is it that I can start now itself? What is better for him, somebody who is new?
Again, to answer this question also, we did an extensive work. What we did, we picked up all those periods where market has corrected more than 20% in the past. So in past 28, 29 years, there are 9 such instances where Sensex, which is a broader market index, has corrected more than 20%. So let's say investor has some magical power and he or she can exactly predict which will be the market bottom. Now the question is, should I start immediately? I know that market is going to fall by 20, 30, 40% in next 1 year, or shall I wait for 1 year to pass and market to correct by 30, 40% and then start my SIP? Now the study reveals that if you are starting SIP at the top, let's say you know the top, versus you start SIP at the bottom, over the long period of time, return from both the SIP in terms of XIR return is almost similar. There is hardly 10 basis point difference or 0.1% or 0.2% difference in terms of percentage return. But the most interesting part is that people who start SIP immediately, let's say this is the top, versus people wait for 8 months, 12 months for market bottom and then start SIP. So people who start SIP immediately, they create more wealth as compared to people who start SIP at the bottom, because the initial installments are the most precious one. Let's say you are running a 10-year or 12-year SIP. If you delay it by 1 year because you are waiting for the bottom, which by the way, nobody can predict, but let's say you have some magical power, you can even predict it and you timed it perfectly. Because you have delayed it by 1 year, the initial 12 installments are the most precious one, because you will get the most compounding benefit for those 12 installments. So people who start immediately and don't wait for the bottom are the one who create most wealth. In fact, even if you start at the bottom, even in a percentage term, there is hardly any difference. So the biggest risk is not the market, but the missing out the opportunity to compound. This is the opportunity to compound to start immediately. So in nutshell, even if you know this is the top and market is going to correct by another 20%, let's say, and even if you are right, I think you should start SIP immediately. You should not wait to start SIP at the market or closer to the market bottom.
Manoj, I'll take this opportunity to solve one of the problems that I have. So we are a mutual fund distribution house. We do mutual fund distribution day in and day out. Every day the customer comes and asks me one question. I'll start the SIP. I'll make a monthly SIP. But which is the best day for me to start the SIP? The customer's question is, I will adjust it to my salary day. And there is a customer who is very religious here. I will start on a Lakshmi day. There is another customer who will say, I'll start on a Venkateshwara Swami day. Another customer says, I'll start on a Raghavendra Swami day. Some customer is moved by numerology. For him, 15th is the best day as per the numerology. There are other customers who will come and say on the settlement day, on the last day of the week, at the last week of the month. So can you help my investors? What's the best day they can time their SIP in a month?
Sure. So again, we did analysis using same 28, 29 years of data with Sensex, and we did analysis assuming that somebody is starting a 10-year SIP. So 10-year is a benchmark that you are running a long-term. 10-year is a good enough period. So somebody would have started on SIP on 1st of every month versus 2nd of every month versus 3rd of every month. Likewise, on 28th of every month. The difference in SIP return for all these investors who started SIP at different date is to the extent of second decimal point. So there is hardly any difference. It just doesn't matter. You are starting SIP on 1st of every month, you are running SIP on 1st of every month, or 15th of every month, or 28th of every month. It just doesn't matter. But better most is that you start SIP immediately and run it for 10 years, 15 years, 20 years. That is the most important thing. Which date you are starting doesn't matter. So my recommendation is that whatever suits you, if somebody is comfortable at first, please go ahead. If somebody believes that 15th is the most auspicious one, okay, start SIP on 15, because it just doesn't matter. What matters is that you start SIP immediately and run it for 10, 12, 15 years.
People also do a lot of research. Google is full of research. WhatsApp University is full of research, right? They ask me, which gives me the highest return? The SIP in small cap, SIP in mid cap, SIP in large cap. What does your study show with this respect? Which is the best SIP out of these three?
So within large, mid, and small cap, data suggests that mid cap is one of the segment. If you are genuine, okay, the keyword is genuine. If you're genuinely long-term SIP investor, now definition is that more than 10 years. If you genuinely running SIP for more than 10 years, mid cap is one segment which proves to be one of the better segment as compared to large cap, both in terms of the potential to generate higher return on an average, and also in consistency also. A 10-year SIP in mid cap index has delivered better consistency as compared to large cap. Small cap index, surprisingly, you find that even mid cap index is not only less volatile as compared to small cap, but on an average has generated better return as compared to small cap index. And the reason is that I think when it comes to doing SIP in small cap segment, the actively managed small cap funds are better suited because they can generate a lot of alpha. A good fund manager managing a small cap fund can beat the benchmark by handsome margin. That is my personal belief over the long term. And hence, if you are running a 10-year plus SIP in actively managed small cap fund, I think small and mid cap is the segment you should look for, but you have to be genuinely long term SIP investor. You should not bother about intermittent volatility. If intermittent volatility of market falling by 20% at some point of time gives you sleepless night, I think you should not start SIP in small and mid cap. You are starting SIP in small and mid cap, you have to invest for at least 10 years.
Investors are also of one variety called the precision instruments. They want everything to be very, very precise. Tell me the correct answer. I will do an SIP. Help me choose one day in a month, or what if you average it out with every week? Or why choose a week? I don't want any one day market will fall. I want to capture that markets don't fall, or I'll do a daily SIP. Which one is better? Daily, weekly, monthly?
So surprisingly, most people believe that if you are doing a daily SIP, you are doing better averaging. But the data suggests that if you are running your SIP for long enough period, whether you are doing daily SIP or weekly or monthly, it just doesn't matter. The return difference is up to second decimal point, and that is hardly, I think, 1 basis point or 2 basis points. So it doesn't matter if you are doing a monthly SIP or daily SIP or weekly SIP. In fact, I personally hate daily SIP. That is my personal bias because I don't want too many transactions in my bank account. See, every investor on an average is running 4 to 5 SIP. That is a ballpark number. Somebody would have been running 10 SIP, somebody is doing only one SIP. Let's say 4 to 5 SIP. So if you are somebody doing a daily SIP and you are running, let's say 5 SIP, daily SIP means in a month, there will be around 20, 25, 20, 22 transactions. Or let's say in a year, there will be 250 transactions because there's about 250 working days or trading days. Now you are doing 4 SIP. That means there will be 1,000 transactions in your bank account in a year. And if you are genuinely running for it for 10 years, there will be 10,000 transactions in your bank account. I think it is meaningless. It is a operational nightmare. And you are not getting any benefit also because I just gave you the data point, last 27 years data point, that if you would have done a monthly SIP versus weekly SIP versus daily SIP, the returns are almost same. So all this operational nightmare for no reason. In fact, what you can do, let's say you are doing a 4 monthly SIP, and we just discussed that date doesn't matter. So you can do one SIP on 1st of every month, second can be 7th of every month, third can be 15th of every month, and fourth can be, let's say, 21st of every month. So by doing this, you are basically doing weekly SIP. So instead of doing, let's say, 40,000 rupees monthly SIP, you do 10,000 rupees for SIP divided into 4 weeks. So it becomes 10,000 rupees weekly SIP. I think this is a good enough diversification you can do. By the way, even doing this diversification will not benefit you in the long term. In the long term, monthly, weekly, daily SIP will generate somewhat similar return.
One of the observations from the stock market behavior is sometimes the large caps move, sometimes small caps move, sometimes the mid caps move. Can an investor change his SIPs from sector to sector as per the flavor of the season?
So again, on this topic also, we were discussing a few quarters back, and we just thought, let's do some analysis to answer this question. Intuitively, we know the answer, but let's answer this question with backed by data. So the data is suggesting that if you are running an SIP in, let's say, mid cap index or a small cap index, and you are changing lane based on what is happening in the market and what is the narrative in the market. Like today, the narrative is that you should do SIP in large cap, and definitely you should stop SIP in small and mid cap because that segment is very expensive or not doing well. So you should move your SIP to large cap. So we did this analysis that a person who is changing lane after the underperformance of a particular segment, it can be small cap or mid cap, versus an investor who is keeping the same lane intact. Let's say I started SIP in mid cap index or small cap index. I run that SIP only in mid cap index and small cap index. I do not change the lane. So people who stick to their lane end up generating more return versus investors who change lane from mid cap to large cap or small cap to large cap based on their recent experience. So I think it makes a lot of sense to stick to your lane. I think that happens in traffic signal also. Whenever we change the lane in which we were previously standing start working. So today also you will have this urge that because small and mid caps are correcting and there is this narrative that they are very expensive, let me stock my SIP and let me start my SIP in large cap. I think if you are a genuine long-term SIP investor, you should continue with small and mid cap over the 10-15 years. This is the segment which can generate far better return, but with a lot of volatility. You have to, like Chandrakant ji also has said that you have to embrace volatility. Volatility is friend. The more volatile segment you are investing over the time should give you better rupee cost averaging.
Investors have to keep one thing in mind. Instead of nurturing the desire that your portfolio should be doing all the time same, instead of that, accept the idea that if possible, select right and sit tight, at least in mutual funds. I can't say the same thing in case of stocks. And time will solve many of the problems. Time is the best corrective, right? So I was talking to my team today morning. Stock market is the only place where negatives are positives. For example, you invest and forget, it's a positive. Forgetting is negative, but that's a positive. Something which takes long time, it could be a negative factor. But in stock market, it works out positive. So stock market is the only place where negative is a positive, whether it is direct lump sum investment or SIP investment. Time will solve many of the problems. Don't become itchy, don't stop it, don't change it, don't have the desire that all the time your portfolio should perform. See, what is not performing over a period of time reverts to the mean. It will, there is a cyclicity, it will perform. The best thing is invest and forget it, and it will play around correctly, and it will catch up with the rest of the whole troop over a period of time. There are invariable studies, and your study is so detailed, it proves that point all over again. Then I have one question for you. Should people be really opting for a top up on the SIPs?
Sure. I think top up is a facility, especially for those investors who are at the early stage of their career. So typically, these are the guys. Let's say we are talking about an investor who is currently salaried investor, and he or she is expecting that in coming years their salary will grow. So what they can do? So what SIP is doing basically is, why do we do SIP? We can every month manually also we can buy now. We manually we can buy a mutual fund unit, but then we are doing SIP because it brings discipline. Because every month you have to take a decision. Otherwise, if you are taking every month decision whether to invest or not, basis on what is happening in India, in globe, you may or may not do SIP. Like it is very difficult to manually buy units in the month of March 2020 or April 2020 or May or June 2020. I mean, there was fear around COVID, and businesses were not working. So there was always tendency not to do SIP or not to manually buy units. So that's why you do SIP to bring discipline. Now, top up SIP is basically you are taking this discipline to next level. You are committing in advance that in coming years, when my salary will be high and I have more surplus money to invest, I will invest that surplus money via SIP only. So SIP brings discipline. Otherwise, if you start doing it manually, it is very difficult to maintain the discipline because of the news flows. Top up SIP, take that discipline to next step to your future surplus amount also. Hence, let's say if you are doing an SIP for 10, 15 years because your goal is 15 years down the line. By doing top up, you can achieve that financial goal in advance. That is how compounding works, because small increment will ensure that something which you are supposed to achieve 15 years down the line, you may end up achieving that thing 12 years down the line. So this is another benefit of doing top up. I think those people who have some clarity of their cash flow and they expect their cash flow to grow, I think they should opt for top up SIP.
Dear viewers, you have already started the SIP, whether it's large cap, mid cap SIP, or some scheme of the mutual funds you have started. Do not stop it right now. Markets will move up and down. That's part and parcel of the market. Volatility is not a loss. Volatility creates a fear. It's a notional loss. When you see your portfolio bleeding, it's not that you have incurred losses. It means if you sell it today, that's the money you are going to get. If your intention is to build wealth for a life goal which is 10 years later, whether market is up today or market is down today is not going to affect you in any fashion. The best thing for you to do is ignore what's happening in the market. Whatever you started, stick to that life goal. Think it's a life normal and everything will fall in place. If you have extra liquidity, make best use of the system. Put some extra money into it. For those of you who started for the first time, don't run away from the market thinking that this is a bad place. It's not bad. What looks to be a bad today appears to be something which is going to be good. Every correction, whenever that happens, appears like a point of risk. When you come out of the correction, it appears like that was the best opportunity that you got to invest your money. So this correction is also going to be the same thing. Don't fear. It's pretty normal thing that is happening in the market. Manoj Jain, thank you very much for assuring our audience about there is nothing in the market which has to be scaring for them. It's not the market which might create problem for them, but it's their behavior of stopping or timing the market that might harm the individual investors. I remain in gratitude to you for your kindness to share all this valuable study for the benefit of my audience. Thank you very much, Manoj. Thank you very much.
Thank you so much to you for inviting me, and all the very best to your audience.
Dear viewers, our channel grows because of your subscription. Our channel grows when you share our content with the near and dear ones. Please do like these videos. Please do subscribe. Please do share these videos with your friends and relatives, near and dear ones, and on all the communities, social medias on which you are connected with. Thank you very much for watching this episode on this Tuesday. Next Tuesday, I'll be back with you with yet another topic, with yet another expert. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.